Hello and greetings from UB. On behalf of the Office of Alumni Engagement and the UB School of Management, we are delighted you are able to join us for today's presentation. My name is Christy Fields and I manage the Alumni Careers and Lifelong Learning program here at UB. It is certainly an exciting month of March as we will be cheering on our men's and women's basketball teams this coming Friday evening as they both are going dancing in the NCAA tournament. It's always great to be a UB Bull. With that said, it is my honor and pleasure to welcome and introduce you to Feng Gu, Associate Professor of Accounting in the UB School of Management. Professor Gu received his PhD and master degrees in business administration from Washington University. His current research interests focus on the relevance of corporate financial reporting and the reporting and management of intangible assets. He has published research articles on these topics in leading academic journals. He is also the author of a recent book titled The End of Accounting and the Path Forward for Investors and Managers. In today's presentation, Professor Gu will provide an overview on why financial statements have lost their relevance and what must be done to restore the relevance and viability of accounting and financial reporting in a modern economy. He will also share insights gained from writing his recent book. We will leave some time during today's webinar for Q&A. If you have any questions during the presentation, please submit them through the GoToWebinar control panel question section on your screen. We will also be recording today's session and will send you all a copy within the next 24 hours. With that said, it's my sincere pleasure to turn it over to Professor Feng Gu.
Thank you, Christy. Thank you very much for your kind and generous introduction. Hello, everyone. It's a great pleasure to talk to you through this webinar today. In today's session, I will talk about my recent book titled The End of Accounting and a Path Forward for Investors and Managers. Let me first start with some background information on what this book is about. Accounting is ubiquitous and important in our economy. In most workplaces, it's hard not to notice the presence of professional accountants and the importance of their everyday work. Given your background as working professionals, I don't think I need to spend a lot of time elaborating on this aspect. You may not realize that accounting affects your personal financial life as well. For instance, your 401k, retirement plan, and a college savings plan have funds invested in the stocks of publicly traded companies all the time. These funds are managed by professional money managers and their analysts who track and analyze firms' accounting information on a daily basis. Given the central role of accounting in economy, it's highly important to make sure that the current model of accounting works well, particularly for users such as financial analysts and investors who predict firms' future earnings and use the prediction to pick stocks and make other investment decisions. If for some reason accounting does not work well, we obviously need to consider how to fix it. These are the general motivation and objective of my book. So let me tell you a little bit more about why we decided to write this book. It was a 3.5-year journey, so lots of work went into it. We must have had very strong reason to believe this is worthwhile. So during the years prior to the writing of my book, we heard a lot of criticism of accounting from some of the most important stakeholders of accounting. So these criticisms are not from regular, ordinary people who know only a few things about accounting. These are from accounting experts. For example, back in 2006, CEOs of 6 largest accounting firms in the world, they directly indicated that the accounting reporting rules produced by Financial Accounting Standard Board, this is the standard setting body of financial reporting in the United States. They complain that these rules produce financial statements that virtually no one understands. They're obviously not alone in voicing this kind of concern. In a recent CFO survey with more than 1,500 global firms in the US and other countries, the vast majority of CFOs who participated in this survey essentially said that they believe financial reporting has degenerated into a compliance exercise with deadweight costs. they obviously don't have very positive things to say about accounting. In 2016, the Institute of Chartered Accountants of Scotland issued a report. This report essentially says that current practice of financial reporting is not sufficient. It cannot capture the full information on the performance of today's enterprise. Now, back here in the U.S., a few years ago, the SEC also gives similar concerns about the usefulness of financial accounting disclosure. So they obviously are concerned about information overload. There's a lot of information available to investors. However, there is a shortage of useful information. The Institute of Chartered Accountants of England, Wales, a few years back, also said pretty much the same thing. Now, recently, a year ago, Deloitte, one of the big four accounting firms in the world, issued a very comprehensive report. In this report, they essentially echoed the concerns given by the CFOs included in that global survey that I just mentioned a minute ago. So they essentially said that in today's reporting practice, compliance is the most important thing, and people just don't care too much about the clarity and usefulness of the information. It's pretty disappointing to hear this from some of the leaders in accounting in today's world. So among all the quotes I have shared with you, the one I like the best, which I think points out to the heart of the problem, is from a letter sent to us from the CFO of a company. In this letter, this CFO essentially said that my investors don't understand the accounting, nor do they care. Is this really true? Well, let's look at some evidence produced by experts in this area. So there is a recent study from two very well-known financial economists. So they look at how active investors are when IPOs, information about IPO firms becomes available on the SEC's website called EDGA. They look at how many times investors actually care to make a few clicks to download the annual report of these new firms that just came to the market for the first time. It's obviously a very important document for investors to have, because this is the first time these firms are providing comprehensive information about their business model, their risk profile, their performance, and so on. So investors, in theory, can learn a lot from such a comprehensive document that became available for the first time. Yet these researchers find that the level of interest from investors in the annual report of these new firms is actually very low. Okay, so for example, they reported that there are only about 28 downloads of the filing during the first couple of days after the report became available. And that's obviously a very small number. Okay, these companies must have a lot more than just 28 investors. This is the picture for newly available firms, IPO firms. What about large established firms, some of the household names? Well, the picture is definitely not a lot more encouraging. So here, the number of downloads during the first 5 days when their annual report becomes available is only 56. Again, these companies must have thousands of investors all over the world. How comes only 56 investors were interested in their most comprehensive reports? That's really mind-boggling. So this is really a very concerning picture from all perspectives as an accounting researcher. Now, the misgiving, the widespread misgiving about accounting in today's economy has also been picked up by mainstream business press. Here I have a sample of Wall Street Journal articles on this subject on the disappearing relevance of accounting earnings from last year to this year. The title of these articles pretty much tell you what they want to say about accounting. For example, one of the articles says the forgotten earnings season. The most recent article from February this year has a title, looks like don't obsess over the earnings season. In this article, they basically said in theory and practice, quarterly earnings just are not that important. So that's definitely not something you expect to hear for such an important practice as accounting is. So what is really going on? Well, if people have a lot of complaints about accounting, I think that gives us enough reason to take a closer look at whether investors still care about accounting earnings and other important accounting information. So this is how I started to start writing this book with a lot of research a few years ago. Finally, the book came out. So today, I want to share with you some of the most important message from the book. In particular, I want to provide you with an overview of the comprehensive evidence that we document on showing the declining relevance of accounting information. I want to talk about the main causes of this decline, as well as our proposals for how to reverse the decline. Before I go on to share with you the key findings of my book and our main proposals, let me briefly take you back in history and show you how accounting report from more than 100 years ago is quote-unquote different from today's version, so we can get a sense of a century of progress in accounting. I will use the example of the accounting reports of U.S. Steel from 1902 and 2012. These two exhibits from my book, the first chapter of my book, put the company's profit and loss statement, also known as the income statement, here on the left-hand side, from 1902 and 2012, side by side. And the same thing for its balance sheet, which gives you information about the company's assets, its debt, and the shareholders' net worth. These are two of the most important accounting reports that investors really want to know before making any major investment decisions. So the reason I selected U.S. Steel was because back then in 1902, U.S. Steel was one of the most prominent companies in the U.S. economy. You don't have to go very far to appreciate this if you just take a look at who was on the company's board. The business titans of those days, such as John D. Rockefeller, J.P. Morgan, Marshall Field, Charles Schwab, who was also the president of the company, and Henry Fried, were on the board of U.S. Steel. So this tells you pretty much how important the company was. Back then, more than a century ago, U.S. Steel was in the business of steel making, as it is today. And around that time, steel making was pretty much the high tech in the economy. So U.S. Steel was one of the most prominent companies. From the income statement going back to 1902, you can see that the company was profitable. Okay, the amount of sales looks much smaller than sales for 2012 for a reason, because these numbers are the original number reported by the company. They were not adjusted for inflation over time. If we go ahead to adjust inflation, to adjust for the effect of inflation by using the consumer price index, then the sales of U.S. Steel back in 1902 would be very comparable to its sales in 2012. So even back then, U.S. Steel was a very large and a successful company, as you can see from the profit number reported by the company in 1902. And by the way, for 2012, the company was not profitable, as you can see from the amount of loss on its income statement. If you take a look at the details of these two financial reports, it's not hard to realize that after more than 100 years, accounting has not made a lot of progress. The structure of these two statements look pretty much unchanged. It's almost exactly the same, except for a couple of accounts on the balance sheet. For example, intangibles and goodwill. Back in 1902, U.S. Steel did not have these two items on their balance sheet because, intangibles was a more recent phenomena, and the goodwill was related to acquisition. And back in 1902, U.S. Steel basically growing its business from inside the company. It relied on organic growth. It didn't do any acquisition. Nowadays, things are very different. So how comes the structure and information item on these two accounting reports, which are apart from each other by more than 100 years, are essentially identical? How can accounting stay in frozen time pretty much, regardless of the large changes in technology, in regulation, everything else in our economy over the last 100 years. It's just mind-boggling. It just doesn't make a lot of sense. If you really want to see any progress over time in accounting reports, probably the only thing I can point out to you is the large increase in the number of pages in the company's annual report. Okay, going back to 1902, U.S. Steel's annual report had only 40 pages, relatively compact. In 2012, it had 174 pages. That would be the only change I can point out. So from this report, you can also get some very quick ideas about what accounting is supposed to do. Okay, for example, on the income statement, it shows the amount of sales, the amount of expenses, and then finally the amount of net income or loss. On the balance sheet on the right-hand side, it gives you ideas about how many assets the company has and what kind of liabilities and equities the company had at a given point in time. The idea of accounting is pretty much like the idea of a scorecard. So if a company can make more profit by using the same amount of asset it has access to, this is obviously a more successful company, and the stock price of such company would go up. So essentially, we expect to see a positive association between a company's accounting performance and its capital market value. And this is what we really want to find out in our first task of examining whether the relevance of accounting information has changed over time. Okay, so here we're obviously using a lot more than just the information of one company. Here we rely on our data going back for more than 60 years, from 1950 until 2013. So we have more than 60 years of data to tell us whether or not accounting performance has a positive association with a company's stock market value. All right. So going back to 1950 and the years shortly after that, here you can see a very high correlation. Okay, almost 100%. It's 90% or higher than that between a company's accounting performance, such as earnings, sales, its assets, liabilities, and the company's stock market value. The relationship is almost 1-to-1. Then as time goes on, if you travel from the 50s and all the way to the 70s and 80s, starting from the mid-80s, things became quite different. Okay, so as of the end of 2013, when we ended our analysis, the statistical association between firms' accounting performance and their stock market value has declined to only around 60%. So over time, we have lost 50% of accounting relevance from this perspective. It's obviously a very large drop over time, 50% over 60 years. So what is going on? Well, this is something we want to keep exploring in our book in order to help people understand what has happened. Maybe you're not very familiar with some of the key accounting terms I just mentioned, but it doesn't matter. You can still understand the loss of accounting relevance over time. Let me show you another picture. You really don't have to be an accounting expert to start appreciating the magnitude of the problem with today's accounting. Just take a look at this trend over the last 50 years, from 1960 until 2016. This graph shows the percentage of firms reporting accounting losses each year from 1960 to 2016. What is so striking here is the ever-increasing percentage of loss firms over time. Going back to 1960, as you can see from the graph, let me just enlarge that a little bit. During the 60s, no more than 10% of all firms had losses. More recently, as of 2016, this percentage has gone up to 50%. Okay, 50% of publicly traded firms had losses as of 2016, and the percentage is much higher among science-based and the technology firms. The percentage of loss firms in this population is about 70%. So take an example of 2010 to 2016, the last segment of our data and the curve here. So this is a period of continuing economic recovery and expansion following the Great Recession. By the way, it's the second longest period of uninterrupted economic growth in the history of U.S. economy. If we add a couple more years, it may become the longest period of uninterrupted economic growth in the history of U.S. economy. Yet, as you can see from this graph, during this period of time, more and more firms were reporting losses. This doesn't make a lot of sense. What is going on here? The answer to this puzzle is actually quite simple. More than half of the loss firms are reporting accounting losses simply because of three accounting factors. Number one, one-time items such as special charges, extraordinary items, and restructuring losses have become a very important part of firms' earnings report. So during this period of time from 2010 to 2016, it so happens that a lot of firms had one-time items, including special charges, extraordinary items, and restructuring losses. So they were directly taken out from sales in the process of computing earnings. That's why many firms had losses. That's reason number one. Reason number two, under the current accounting standards, whenever a firm invests in R&D, research development, in brand name development, in employee training, and so on, these two categories of expenses are directly taken out of earnings when reporting earnings information. So essentially, the more a company invests in R&D, in employee training, in brand development, the lower the company's earnings will be for this period of time, regardless of the beneficial effect that these spendings will have for the companies for years to come. So this is why more and more firms over time are reporting accounting losses. Now, there's another way to demonstrate the loss of accounting relevance over time. And this is detailed in an article I published in 2017. So the idea of this test is as follows. In order to find out the real value of accounting information, we can essentially run a test that examines the economic advantage of somehow knowing a company's earnings information ahead of time. So this is like somebody has a perfect prediction of a company's future performance. I mentioned earlier to you that every publicly traded company is followed by a good number of financial analysts who try to predict the company's future earnings. So if people believe a company's future earnings will go up compared to its current earnings, stock price will generally go up. As soon as people figure out this is going to happen, they're going to beat up the stock price, so you see an increase in the value of the company. So in this test, we have a very strong and perfect prediction of future earnings, not just for how much a company is going to earn on a quarter-to-quarter basis, but also if a company is going to meet or beat the forecast given by average analysts, the so-called consensus forecast. So in capital market, if a company is able to beat the consensus forecast issued by all analysts following the company, it's viewed by investors as a very strong form of performance. So the stock price is going to go up even further as soon as this happens. So in this test, we essentially try to find out how much profit an investor can earn if this investor has a perfect foresight of whether or not a company is going to meet or beat consensus forecast. So obviously, this doesn't happen in reality. Nobody would have this kind of perfect foresight, but it nonetheless gives us a sense about the highest possible economic value that accounting information can give to investors. And this also explains why analysts invest in their earnings prediction model. So if we run this test, the graph here shows you that going back to the late 80s and early 90s, there was tremendous economic advantage to have a perfect forecast of whether or not a firm is going to meet or beat consensus forecast. So the abnormal stock return, this is the stock return of a company after we take into account all risk-related factors, the so-called abnormal returns. So the normal returns of companies around that point of time in the late 80s and early 90s was about 6% on a quarterly basis, or about 24% on annual basis, which is quite large because it's after we take out the effect of all risk-related factors. As you can see from the graph, as time goes on, the advantage of this perfect forecast, perfect prediction, has declined. When we ended our test in 2017, the value of such a perfect forecast model is only about 2%. It's actually below 2%, which is not very impressive at all. So it gives you a very clear idea about by how much the economic value of earnings information has declined. It's a very dramatic decline over time, from 6% each quarter to less than 2%. It's a very large drop. All right. So if you go back to some of the financial press article I just mentioned, the same concern has been raised by the insiders of the market who understand what is going on from what they're doing on a day-to-day basis. So here in this article from Wall Street Journal a year ago, essentially points out that earnings have become irrelevant. We used to say that earnings move market, not anymore. This article essentially said that this is true for both U.S. and European companies. So we're not just talking about a U.S. phenomenon. This is a lot more than that. And then here I also have some quotes from a research report put together by a very large asset management firm called Oakmark Funds. They manage more than $21 billion of assets. So in this report, they essentially point out that earnings no longer matter. It's not just earnings, also the book value that a company reports on its balance sheet also gives little clue as to its stock price. So they realized this became a problem 25 years ago. So it has been a while that some really sophisticated investors have figured out that accounting information has lost a lot of relevance over time. This is why we decided to use the title, The End of Accounting, to give people a clear idea about the problem we're looking at and the seriousness of the issue that we have to understand. Okay, so I think I've given you enough information on the evidence that we have documented showing the declining relevance of accounting information over time. So in the next part of my presentation, I'm going to shed some light on why accounting information has lost relevance over time. This is a very important part of our book. We probably spent 5 or 6 chapters to document step by step why accounting information has lost relevance over time. We identified 3 important reasons that are responsible for the loss of accounting relevance. So we undertook a lot of research to identify these reasons. So here's a list of the 3 reasons that are responsible for the loss of accounting relevance from our perspective. The first factor is the rise of intangible assets over time and the absence of these assets on a company's financial reports and the distorting effect this absence has on a company's accounting information. So under current accounting rules, as I mentioned earlier, with a few exceptions, when firms make investment in intangible assets, the investment is treated as the current period expenses. So they're deducted 100% from the earnings report of the current period. As a result of that accounting treatment, important accounting numbers of a company, such as total assets, its equity, and the firm's performance metrics, earnings and earnings-based performance metrics are all distorted. So some firms, the ratios are overstated. For other firms, the ratios are understated. So the distortion is actually quite complicated. We have some very detailed discussion for why this is the case in the book. So if you're interested in understanding what is happening in this area, definitely our book would provide you with a lot of detailed information. So that's the first reason. The second reason is the increasing use of estimates in accounting reports. I'm going to give you some more details in a couple of slides on this reason. The third one is the continuing ignorance and delayed recognition of important business events in accounting reports. When something really important happens that investors should know and really care about, for some reason, the information about these events is not included in accounting reports. When it's finally reporting accounting numbers, it's always years and years later, so it doesn't matter anymore. Okay, so let me talk briefly about the first factor, the rise of intangibles. What are intangible assets? Well, if you look around the most dominant companies in today's economy, many of them actually rely on their intangible assets. So intangible assets are all over the place and deeply embedded in our economy today. Broadly speaking, there are three categories of intangible assets. The first one is related to a company's capability of discovery and learning. So this allows the company to convert its investment in research development, R&D, into highly valuable patents, unique software, powerful copyrights, unique product design, and useful databases on customers and everything else they want to know. So that's the first category. The second category of intangibles relates to a company's ability to interact with its customers, which allows the company to convert its investment in market research into valuable brands, well-recognized trademarks, effective online distribution channel, and marketing alliances with other firms. So that's the second type of intangible assets that many successful corporations have these days. The third type of intangible assets is more elusive than the first two types of intangibles. So this is based on the idea of organization design development, such as business process improvement and employee training for the purpose of improving the efficiency and effectiveness of a company's business process. This is often translated into supply chain integration, internal integrated production inventory management system, and so on. It's a little bit difficult for outsiders to appreciate because they don't take any specific form. So why do we care about intangibles? Well, a lot of books have been written about intangibles. The reason we care about intangibles in our research is because of the way they're treated in accounting reports. Although they're highly important, they're not treated as any type of assets in accounting reports under most cases. So there, as I mentioned before, whenever a company decides to invest in tangible assets, the investment amount is treated as expense of the current period. You don't see any assets, and some of the key accounting numbers are distorted because of that reason. So why does that matter? Well, if you look at a graph on the left-hand side here in my slide, you can see that there are two very important trends going on in the investment area of our economy, the U.S. economy, from the late 1970s until 2013. So over this period of 40 years, the orange line shows that the amount of investment in tangible assets such as building, equipment, machinery, the so-called brick and mortar type of investment has been going down from about 14% of our national economic activity to less than 10%. Okay, so we're talking about a more than 30% decrease over time. In the meantime, the investment in all sorts of intangible assets such as R&D, software, brand names, employee training has been going up from less than 10% of our economic activity to more than 14%. So we're talking about a 60% increase over time in this type of investment. Okay, the most dramatic changes started happening around the 90s, from the early to mid 90s. So that's also the time when IT revolution was starting to have a real impact across all sectors in our economy. So over time, there's no denial that intangible investment has become the most dominant form of investment in our economy. And yet, if you look at the accounting relevance of firms that came to the public traded market over different decades, from the 50s to 60s, 70s, and so on, they show very different characteristics. The earliest generation of firms during the 50s, they didn't have much investment in intangibles, as shown by the orange line, investment in R&D and other types of intangibles. And their accounting relevance was very high. These are some of the old industrial firms that don't have much new technology, okay? Every decade, when we move from the previous generation to a newer generation, two things happen. Number one, the newer generation of firms always invest more in intangibles, as shown by the orange line. And number two, their accounting relevance continues declining over time. So this is a trend that has been going on over the last 60 years. If you look at the most recent crop of IPO firms, they invest really a lot in intangibles, about 31% relative to their sales, and their accounting relevance is very, very small. So that's because of the way intangibles are treated in accounting reports. It just doesn't capture the most relevant information. Now, speaking of the relevance of accounting estimates, here in one of the chapters of our book, we spent a lot of space to carefully document the dramatic increase in the use of accounting estimates from the mid-90s until 2013. So here it's based on a sample of 50 of the largest U.S. companies. And you can see that the frequency of using estimate in accounting reports has exploded. So why does this matter? Because many of these estimates are not reliable. They're subjective and they're based on very unverifiable assumptions and subjective information managers have. They can be manipulated by managers. So if you allow firms to use more and more unreliable and subjective numbers that are based on estimates in their accounting reports, you're going to have bigger and bigger problems. Investors are not going to view earnings and other accounting numbers as relevant because of this problem. Okay, so to summarize what I have just explained to you, under the current accounting system we have, which is driven by the decision made by accounting standard setters, over the last 30, 40 years, we have paid a lot of attention to the balance sheet at the expense of income statement and other parts of accounting structure. So because of the use of more and more estimates and the absence of intangible assets, our balance sheet and income statement have become very problematic. This is why they have lost a lot of relevance over time. So essentially, accounting is not about facts anymore. Some of the most important investment made by the company is not captured on accounting reports, and what is included there are based on a lot of unreliable estimates. This is what has been going on for the last 20 to 30 years in accounting reports. So, does this matter? Well, I already mentioned to you some of the evidence about declining relevance. Okay, some people may say, well, that's just for everyday investor. Sophisticated investors and analysts can figure this out. This is not the case. As we documented in our book, the uncertainty, which reflects the way analysts look at earnings information, has been rising over time. So this is the forecast dispersion, which reflects the extent to which analysts have confusion about a company's earnings numbers. This has been an increasing trend from the 70s until the most recent period. Some people may say this is probably due to the increase in the uncertainty of our economy and volatility has gone up over time. This is why analysts have a difficult time forecasting earnings. Well, not completely true. We have another chapter in our book documenting the decrease in the volatility of corporate activities. And this is actually very consistent with the research done by economists. So economists have documented for quite some time that the level of uncertainty and volatility has actually have decreased over time in our economy. So here we extended this analysis to corporate sales activity, and we show exactly the same pattern. So obviously, the increase in analysts, uncertainty about future earnings is not driven by the trend of volatility in our economy. It's a different reason. So this is what has been happening. Our accounting model is really problematic. It has an incorrect focus. It's basically self-inflicted wounds. It's not driven by important economic trend. It's just driven by the decision made by accounting standard setters. They ignore intangible investment. They allow firms to use more and more accounting estimates. This is what has been driving down the relevance of accounting information. Okay. So in the last part of my presentation, I'm going to quickly share with you the key ideas of our proposal about how to reverse this trend. So now we understand the reason behind the trend. The proposal ought to be quite straightforward if we target on these factors. So first of all, we propose that we ought to treat intangible as assets in accounting reports. Don't just ignore them. Don't expense them. Treat them as assets in exactly the same way as their tangible counterparts. That's the first proposal. The second proposal is to reduce the use of accounting estimates, particularly unreliable estimates. Okay. The third proposal is to come up with a new tool for reflecting what is the most important information investors really care about. This is what we call strategic resources and consequences report. This is intended as a framework for more relevant disclosure. It's also a tool for managers to organize their information when they decide how to provide useful information to investors in a more integrated way. And the focus of the report is based on what really matters to investors and managers. So how do we know what matters to investors and managers? We don't just assume. We actually spend a lot of time reading the earnings conference call transcripts by hundreds of companies over a long period of time in order to understand what questions investors really have for the managers of a company when they report accounting information. So based on this analysis, we put together a proposal in this part. So essentially, our proposal focuses on a company's strategic resources, which are the type of resources that can generate net benefits for a firm. They're in limited supply and difficult to imitate by others. And the reason we focus on these resources is because they're the key for achieving and sustaining a company's competitive advantage. Okay, so in this proposal, we recommend that firms provide information mapping investment resources. They provide information on efforts and success in preserving and renewing strategic resources. They provide information on how firms deploy their strategic assets in their operation and what kind of results, okay, particularly the value created by the deployment and investment. So here's a slide showing the general structure of this proposal, the Strategic Resources and Consequences Report, divided into 5 areas of information. Okay, here is an example showing how this report will look like for SiriusXM. Many of you use the service provided by SiriusXM in your satellite radio in your vehicle, so you may be familiar with this, with the business model of this company and how it operates. So this is based on the general model I just explained to you, with a lot more details based on what this company is sharing with investors. Does this really work? Here I have a very brief example on SiriusXM. It tells you that if you look at earnings report for the last 2 quarters of 2017, the earnings information, as you can see from here, really don't provide you with an accurate picture of the company's performance. It shows a loss from the 3rd quarter to the 4th quarter, a pretty large loss. However, if we use the new report we propose to calculate the so-called customer value, which is the most important asset of the company, strategic asset, it shows the opposite trend. There was a small increase in the customer value by slightly less than 1%. And it's reflected in the company's stock price relative to the market. During this period of time, the company's stock price went up by 10.4%, which is actually the same performance as the S&P 500 index. So essentially, it's telling you the same thing, that because of the very small amount of customer value change, there's no increase or decrease in the company's stock price relative to the general market. And this is not what you see from the earnings report. If you focus on earnings, it shows you a much more negative picture. So we believe this is a more accurate way to capture what matters to investors for the company's performance. So this is pretty much everything I want to share with you about the key message from my book. And next, we would like to open the floor for questions. Christy?
Yes, Professor Gu, thank you so very much. Really appreciate everything that you shared with us. And we have a couple of questions that have come through, so I will start with those. The first question that was submitted, does your consensus data include whisper numbers? What analysts really expect but don't put up on first call?
I don't think our consensus number includes whisper numbers, because whisper numbers did not become widely available until late 90s. And if you recall, in the early graph I was showing you, our analysis went back much further to the late 80s. And also, there is no reliable definition of whisper numbers. They're normally available shortly before earnings announcement. So it's some sort of market expectation shortly before actual earnings are released.
Great, thank you. And then also the next question that was submitted, what happens if you lag the stock performance versus financial indicators? In the original days of Graham and Dodd, stocks were highly speculative and moved after earnings were reported. And today, stocks move in anticipation of headlines. Note that for pharmaceuticals, it's used to buy on the clinical data and sell on the approval. And now it's buy on the rumored clinical data or expectations and sell on the reported data. Do you have any thoughts on this?
Yeah, this is actually a very good question. Nowadays, it's very common to see stock price moving ahead of the release of actual news based on what people expect to see. So you're absolutely right. If it's just rumors, obviously, if rumors are not accurate over time, and then people are not going to trust the rumors. I think it's more important to look at some of the key indicators I mentioned during my presentation, especially those related to the strategic resources of a company. Take an example of a pharmaceutical firm. So if a company has success in a clinical trial or the FDA approval of its upcoming drug, obviously this is going to become a very important piece of news, for their stockholders to have. Speaking of the problem with rumors, as a manager of these firms, you obviously want to get ahead of the rumors. So this is why we believe it's relevant for pharmaceutical firms and other types of firms to share information on their strategic resources on a periodic basis. This is going to make sure that they take control of the communication between the firm, their investors. I think, relatively speaking, investors will probably have more faith in objective and reliable information that directly comes from the manager of the firm instead of some kind of rumors from internet chat room.
Fantastic, thank you. And then Professor Gu, the next question that was submitted, what are the implications for investment managers and stock analysts? What does this mean for traditional valuation methods like PE ratios and the like? Are measures like cash flow more representative?
This is a very good question. I'm glad someone read this question. So if you follow the message in my book that I just presented, it's essentially telling you that traditionally used performance indicators such as PE ratios and earnings growth, earnings momentum, they're highly problematic for several reasons. The number one is the exclusion of intangible investment in accounting reports. So they don't show up in the company's assets, and they don't become part of the income statement. I mean, they are excluded, they are deducted from income statement expenses, but their benefits don't show up years later. So that's why there is a problem of using these metrics to make investment decisions. Speaking of cash flow, cash flow analysis is obviously very important, but unfortunately it does not capture all the key information. For example, when a company is starting to make investment in strategic assets, even before the investment becomes productive, you want to know what the company is investing, how the investment is performing, Are there early signs of success? And all these aspects are not going to be captured by cash flow information until years and years later. So this is why no analysis in this area is going to capture everything. That's why you have to expand, your attention to include non-traditional analysis, including those I propose in the book that focuses on a company's strategic assets and its investment.
Great, thank you. The next question submitted, maybe just to see if you have any thoughts or advice for this question. If R&D is capitalized, isn't that adding another estimate to the statements? An estimate that the work will be successful, and how do changes to those estimates flow through?
It's a great question. I'm glad somebody raised that. So there's a lot of misunderstanding when we talk about this type of proposal of capitalizing R&D. Now, to make things more clear, let me just explain a little bit more about exactly what this proposal calls for. We're not advocating the idea of asking companies to periodically valuing, the investment in R&D by changing the number they put on their balance sheet for this type of asset. Instead, our proposal is very, very modest. We're simply asking for the idea, we're simply proposing the idea of treating R&D investment as an asset. So, for example, if a pharmaceutical company decides to invest $300 million in the development and discovery of a new cancer drug, so every year under this proposal, the amount of investment would show up on the income on the balance sheet as some sort of asset, exact the same way as the investment in machinery, equipment, building, and so on. Over time, if the investment becomes unsuccessful, then under the current accounting standards of asset impairment, firms will be required to write off the value of their investment, whether the investment is in the form of tangible assets or intangible assets. So in this part, our proposal is not different in any way. Of course, when the investment becomes successful, we also follow the accounting tradition of, not asking companies to write up the value of the investment. So the idea of this proposal is just to make sure that R&D investment is treated in exact the same way as investment in intangible assets such as building and equipment, not any different.
Excellent, thank you. Those are great questions and wonderful responses as well, Professor Gu. Thank you so much. I know those are the questions that have been submitted thus far. If anyone has additional questions, please let us know, and we can be sure to share those with Professor Gu in the coming days and get those responses out to you. So Professor Feng Gu, just on behalf of the Office of Alumni Engagement and the UB School of Management, I really would like to thank you for sharing your time, your knowledge, your expertise, and your most recent book with us as well. We are so grateful for the time you've given us today. As a reminder, this webinar has been recorded, and we will send you all the link within the next 24 hours. We would love for you to save the date for our next few upcoming webinars on Wednesday, March 27th. Linda Bucher, who graduated from the UB School of Management, she's going to return to share some insight on stepping into your power to advance your career. On Wednesday, April 3rd, you can get to know the UB Career Connector Network. We're going to have our representative from Firsthand show us how easy it is to register and access the platform as both a mentor and mentee. And then we have a special edition webinar on Thursday, April 4th. We're going to kick off National Public Health Month. And this webinar is going to be presented by UB alumna Jackie Andula, who will speak to vaccinations and why they are vital. In addition, we have many other webinars coming through the month of April from our athletics department, our experiential learning team, as well as going into May, having some other guest speakers and professors from the School of Management. So stay tuned for some upcoming webinars in the next coming months. But thank you so much for taking time to join us today. Again, thank you so much, Professor Feng Gu. UB is more than a place. It's a way of shaping the world, engaging ideas, and inspiring action. So thanks again for joining us. Enjoy the rest of your day, and as always, go Bulls.
Thank you for having me. It's a great pleasure to be part of this.
Thank you.
Yeah, you're welcome.
Bye-bye.